Hello, this is Jordan, and this video is being recorded on Friday, October 1st, 2022. Thank you so much for joining me. In this video, I'm going to discuss why gold fundamentals are not bullish, at least not yet. Please like, comment, and subscribe if you're watching this on YouTube. So we know that the clear, overwhelming driving force for precious metals in terms of fundamentals are declining real interest rates. So gold is inversely correlated or negatively correlated to real interest rates. In this chart, we have at the top, it's a weekly line chart. That's gold with the equivalent of the 40-month moving average, very important moving average for gold, as I've discussed in many videos, including the last video. And below that, we have a variety of real interest rates. The first two indicators are calculated from the TIPS market. These are market-based indicators. And then at the bottom, we have just the simple real Fed funds rate, which is just calculated from the Fed funds rate and the rate of inflation, which comes out once a month. That's the CPI. So that is a lagging indicator. However, I think over time and historically, that is a more accurate indicator than the other two. But again, it's lagging. And with the case of all of these, you really need to anticipate what they're going to do. I mean, they can change, they can stay the same. So they're not leading indicators per se or lagging indicators. But with all that said, I've discussed this in other videos, but since a year ago when gold peaked, the market has had the expectation of higher real interest rates, or at least real interest rates were not going to decline any more than they already did. I mean, they really blew out to the downside. They declined significantly because the CPI hit, 5 or 6% in recent months. So the market was factoring that in well before it happened. And so, I mean, I highlight real interest rates there. You can see since the gold market peaked, and the market, since that point, I mean, it thinks that inflation is going to decrease in 2022. And at the same time, the market now, it's pricing in tighter Fed policy. Bond yields are rising. The expectations for a rate hike are rising. So the market is sensing higher real interest rates to come. Now, it has been sensing that for a while. So time will tell if the sensing of that is premature or too long in the tooth or incorrect. Time will tell. But that's the reality here and now, is that the market is sensing, and I agree with the market, that real interest rates are going to increase. Now, since gold peaked, real interest rates, they didn't rise. They didn't really go down that much. They stopped going down for the most part. And gold performed really, really well because real interest rates were declining dramatically, and that's what the market expected. So we had a very sharp decrease or expectation of, and the issue is when that stops, I mean, as long as it stops, that's negative for gold, and so it doesn't have to rise that much to be negative for gold. So that's the situation that gold is in now and gold has been in. And again, the combination of the market discounting, moderating inflation next year, and bond yields rising, that means higher real interest rates. So the fundamentals, at least in the immediate sense and in the near term, they're bearish for gold. That's why gold has been performing poorly. That's why, all precious metals have been performing poorly. Now, that's the reality. And, this is a chart. This is a chart of the last 7 years. You can see I have the stock market at the top, gold in the middle, GDX at the bottom. And if we look at the last 7 years, the three most significant lows in precious metals, they coincided with stock market corrections. And two of the three coincided with shifts in Fed policy. I mean, you had the first rate hike at the end of 2015, exactly when gold bottomed. And you had the last rate hike, December 2018. The Fed was shifting policy then. I mean, they ended up cutting within, when did they cut? June. I mean, they signaled the cut in May. So they shifted policy pretty quickly. And in fact, the gold market since that before the last rate hike. I mean, gold, remember, it bottomed in August 2018. So the last rate hike was actually 4 months after that. And then you had the COVID crash. And of course, that brought about, interest rates being cut more aggressively and a huge amount of fiscal stimulus. So, essentially, we're talking about fundamentals in the last chart, and then here we're talking about catalysts. And I've said this before, the next catalyst for gold, significant catalyst, it's a significant stock market correction, on the order of 15%, give or take, or you have the Fed hiking rates for the first time. Because I've said this in the other video and in my work, check back historically, the first rate hike, it's always bullish for gold. I mean, 6 out of 8 times. The other 2 times were in the 80s. They don't apply to today because gold was rising into those hikes, like rising for several months and significantly. So the other 6 times, I mean, it's a no-brainer. Gold rebounds with the first rate hike. But, the odds of a stock market correction, they are increasing. And that could take a few more months to play out. So that's something, obviously, you get a stock market correction that is going to tend to coincide with real rates decreasing, or at least the stock market corrects and then real rates tend to decrease after the correction. So that's why it that tends to be bullish for gold and precious metals. And at the same time, the odds of a rate hike have been creeping up. I think I checked a couple days ago, there was a 47% chance of a hike next September. It's basically a hike is basically priced in by the end of next year. There was one of those Fed blowhards said that they could see 2 hikes next year. So these are all the things to consider with precious metals. I mean, just to conclude, the immediate fundamental situation, it's not bullish for precious metals. However, if you look at the other things I mentioned, I don't know what the timetable is. Maybe it's a couple months, maybe it's 6 months. Who knows? But aside from the very short term in the next couple months, it appears that fundamentals for gold can turn more positive. And it could be, next year, it could be some kind of a whiff of stagflation. It could be, yes, the market is discounting, inflation is going to come down. But maybe inflation stays sticky. Maybe it doesn't come down as much as people think. That would be bullish for gold. And at the same time, if you have that development and you have the economy slowing down, there's concerns about growth at the same time as inflation staying sticky, then you get increased fears of stagflation. The stock market is probably not going to perform well during that period, and that's a bullish catalyst for gold. So, again, we'll weigh. I always weigh this fundamental analysis with the technical factors, but and the technical factors will turn first. The gold market, it's already pretty oversold. Maybe it gets extremely oversold. And it hits a bottom before these fundamental factors turn. But my point with this analysis is, first, fundamentals are not bullish now. But second, it's easy to see as we get into next year how fundamentals can revert back to being bullish for gold. So that's the takeaway here. I hope you enjoyed the video. Let me know what you think. And I look forward to doing another video for you guys in the days and weeks ahead. Thank you.